Hey guys, welcome to another episode of Money Talks with Njideka. On today's episode, we are going to talk about IRAs and the difference between a traditional and a Roth. So, traditional IRAs, or individual retirement accounts, were created years ago in 1974, and they're owned by over 36 million U.S. households. The Roth IRA was created years later. It was actually created as part of the Taxpayer Relief Act in 1997. Now, those are owned by almost 25 million households. Now, both are IRAs, but both are quite different. So, I'm going to talk to you about those differences. So, up to certain limits, traditional IRAs allow individuals to make tax-deductible contributions into their account. That means that you can write them off on your tax return, okay? Distributions from traditional IRAs, meaning the money that's paid out, right, when it's time for you to retire, now that's taxed because it didn't get taxed before, okay? It get taxed as ordinary income. And if you take that money before age 59 and a half, you may be subject to a 10% federal income tax penalty. Generally, with traditional IRAs, once you reach age 72, you must begin to take required minimum distributions. They're called RMDs, all right? The government will force you to take those distributions, okay? So for individuals covered by a retirement plan at work, the deduction for the traditional IRA, at least in 2021, it's phased out for incomes between $105,000 and $125,000. So if you make between those and you are married, filing jointly, you will not get the deduction for the traditional IRA, okay? If you are a single filer and you make between $66,000 and $76,000, that's the phase out. So anything above that, you cannot get the deduction, right, that the traditional IRA offers. So also within those limits, certain limits, individuals can make contributions to a Roth IRA, okay? So the traditional IRA is with pre-tax dollars, a Roth IRA is with after-tax dollars, basically the money that's coming out of your bank account, okay? To qualify for a tax-free penalty withdrawal with the Roth IRA, you must meet certain requirements. So you have to have that Roth IRA for 5 years. There's a 5-year holding requirement. And that distribution, right, meaning when you take the money out, it has to occur after age 59 and a half. That's how you can avoid that 10% penalty. Like the traditional IRA, contributions to the Roth IRA are limited based on your income, okay? So for the year 2021, contributions, right, the money that you put into the Roth IRA, now those are phased out between $198,000 and $208,000 if you are married and you file jointly, okay? If you are a single filer, your phase out limits are between $125,000 and $140,000. After that, you can't get the same benefits, the same tax-free benefits that others get, all right, for that Roth IRA. In addition to the contribution and distribution rules, there are also limits on how much can be contributed each year to either IRA. In fact, these limits apply to any combination of IRAs, okay? So what that is, it means that if you are a worker, you cannot put more than $6,000 per year, $6,000 per year into either their Roth IRA or traditional IRA, okay? And this is combined, so you can have both. One person can have a Roth IRA and they can have a traditional IRA, but between both, you can only put $6,000, meaning if a worker contributed $3,500 in a given year to a traditional IRA, okay, contributions to their Roth IRA will be limited to $2,500 in that same year. So individuals who reach age 50 or older, okay, by the end of that same tax year can qualify for something called a catch-up contribution. That means that while the normal limit, right, contribution limit to IRAs is $6,000, if you are 50 or older, they actually bump that up, okay? So they give you an extra $1,000. So the combined limit is instead $7,000 instead of $6,000, okay? With both the traditional and the Roth IRA, both can play a part in your retirement plans. And once you've figured out which one works better for you, only one task remains. Just open the account, okay? So in summary, the features of traditional IRAs versus Roth IRAs in terms of the tax deductible contributions, right? Meaning the money that you put in. So which account offers tax deductible contributions? The traditional, okay? The Roth IRA does not offer tax deductible contributions. Which one offers tax deferred growth, meaning as the money is working in that account, right? The IRS is not requiring you to pay taxes on that. Both of them have tax deferred growth. which one has tax-free withdrawals, meaning the money that you actually take out, right, once you retire. The traditional IRA does not. The Roth IRA, you can have tax-free withdrawals, all right? And again, remember, it's based on the income limits. And finally, which one requires distributions at age 72? The traditional requires distributions at age 72. The Roth IRA does not. Thanks so much for watching. I hope you learned something today. If you have any questions, please be sure to post them in the comments below, and please remember to like and subscribe. I will see you on the next one.